In this video, we're going to talk about E&P, which stands for earnings and profits. So E&P is not actually defined in the tax code, but what E&P is it's something that measures a corporation's ability to pay out dividends. So it's trying to track a corporation over time and say, okay, how much of earnings and profits have you built up? Because if you say, okay, this corporation has 100,000 in earnings and profits, then when that corporation makes a distribution to the shareholders, it makes sense. You say, oh, there's 100,000 in earnings and profits. We could classify that as a dividend. And we'll talk more about that in the videos to come. But right now, I just want to talk about how we'd go about calculating earnings and profits. So first off, E&P is calculated. You've got a current E&P and an accumulated E&P. First, I want to show you how to calculate current E&P, and then accumulated E&P will actually be quite easy. So to calculate current E&P, you start out with taxable income. So whatever the corporation's taxable income for the year, that's your base that you start with, and then you're going to make adjustments. So you're going to adjust taxable income. You're going to add some things. You're just going to subtract some things. So you're going to add, for example, any income that was excluded from taxable income. When you were computing taxable income, when you were getting this number here, any of the items that were excluded from that, but are included for E&P. So for example, if you take like life insurance proceeds are excluded from taxable income. However, they're not excluded from E&P. So if we start with taxable income and this life insurance proceeds is supposed to be in the E&P, but it wasn't in this taxable income number, then we have to add it. Right? We're going to have to add it. And then you might have a situation where there's some kind of deduction that's not allowed for taxable income purposes, such as federal income taxes. So when you're calculating your taxable income, you can't deduct federal income taxes from that. But these deductions are allowed for E&P of federal income taxes, right? There's a number of these. I'm just giving you an example. But because that deduction was not allowed for taxable income, but it is allowed for E&P, then we need to go ahead, we need to subtract that. Now, any deductions that are allowed for taxable income but are not allowed for E&P, we're going to need to add. For example, things like the domestic production activities deduction, the dividends received deduction, those are deductions that are allowed when you're calculating taxable income, right? Our starting point, but they're not allowed for E&P. So basically think about it like this. Our taxable income is lower because of these deductions, but we need to add them back. We need to add them back to get the current E&P, right? So we're just thinking for 1 year. Let's say we had just started a business. We'd look at, okay, what's our taxable income for the year? We're going to add this. We're going to subtract this. We're going to add this. And then there might be some other things too. Maybe there was some deferred gain on an installment sale or something that was not included in taxable income. It should be an E&P, or there's some kind of depreciation adjustment or something like that. And it can get actually quite complicated. So basically, but we're going to make all these adjustments, right? We're going to start with taxable income. We're going to make all these adjustments, and that's going to tell us for the year what happened to the E&P. That's the current E&P. So I just want to give you an example, and then we'll talk about the accumulated E&P. So let's say that you start a company called Healthy Ice Cream. So that you incorporate healthy ice cream, and wouldn't that be wonderful if we had actually healthy ice cream? You could be the person to do that. So you've got this corporation, and so at the end of your first year of operation, so you just started up, and now this is the end, you've done 12 months of business, you look and you say, oh, taxable income is $85,000. So you've got taxable income of $85,000, but then you notice that, hey, I have municipal bond interest. So like maybe you own bonds in like the state of Illinois or something like that. You own some kind of municipal bond and you got some interest from that. And so you got $11,000. And so that's exempt for federal income tax purposes, right? So when we're calculating that taxable income of this $85,000, we did not include this municipal bond interest of $11,000. So if you think about when we go to calculate the current E&P, this is basically income that was excluded from taxable income, right? So, but now we're going to have to add it back. So this is going to get added. We're going to add municipal bond interest, okay? Now, let's see if there's anything else we got to do. Well, let's take a look at our federal income taxes, right? Surely we probably paid some federal income tax. Let's just assume it was $30,000, okay? So that deduction is basically, it wasn't allowed. It was not allowed for taxable income purposes, but it is allowed for E&P. So we didn't get that deduction when we were calculating this $85,000. So now we're going to take it. So we're going to say, okay, minus that $30,000. And then let's just say too that you bought, you had stock in another firm and you received some dividends, and you take a dividend received deduction of $4,000. Well, that is a deduction that's perfectly fine to take when you're doing your taxable income. However, it's not allowed for E&P. So we're going to add that back, right? So we're going to add the dividend received deduction. And now we can go and say, okay, what's our current E&P for the period? Remember, we start with this taxable income, then we added the municipal bond interest, and then we subtracted federal income taxes and added dividend received deduction. So you've got $85,000 plus $11,000 minus $30,000 plus $4,000, and that's going to give us 66. It looks like my math is right, $70,000. So our current E&P for this year is $70,000. Now, if you said, well, what's the accumulated E&P? The accumulated E&P is just everything from the past, right? Everything from years before this one. Now, this is a startup. This was your first year in business, so your accumulated E&P is zero, right? Now, let's pretend that we go into year 2 and that you didn't have any dividends or any kind of distribution. You had nothing happen that would affect your E&P balance, right? So now when we go into year 2, so let's just put here, I'll say year 2. So this was year 1, and then year 2. So year 2, this 70,000 is actually going to become the accumulated E&P because it's from the past, right? When we look forward to the future as of year 2, this 70,000 was from year 1, right? So that's now the accumulated E&P. Now let's just say that the current E&P for year 2, let's say that it ends up being $15,000. So you go through you start get your taxable income from year 2, you make all the adjustments, and it ends up being $15,000. Then if there's still no distributions, that would be later added to the 70, and it'd be 85 for year 3, and so forth, right? So that's how that works. Now you might be wondering, why do we care what's current, what's accumulated? Why don't we just have one big account? Why don't we just put it all together and just say, for example, here, why don't we just say, it's 85,000. Why do we care what's current and what's accumulated? That's an excellent question. And the answer is because when we go to, so let's say we have a dividend distribution. Let's say there's a dividend distribution to shareholders of, let's just say $40,000 or something like that. We're first going to look to current E&P, right? We're going to look to current E&P, and we're going to say, okay, what's the current E&P situation? And the dividends, so this is 40,000, would first come out, the 15 would go to 0. So the dividends first come out of the current E&P, because dividends, and we'll talk about this more when we talk about dividends, but dividends reduce E&P. So current E&P would go to 0. And then accumulated E&P, so you'd have 25 left, so that would be 45. So this would go to 45,000, right? So that would be what happens. Now you might say, okay, well, still, I don't quite see where there'd be an issue here or anything like that. Let me just give you kind of a weird example. So let's ignore all this for a moment, and let's say that the accumulated E&P for a year was actually negative. So let's say it was negative 85,000, and then the current E&P is still 15,000, right? Let's just forget all this stuff before, right? I'm just giving a hypothetical. So if accumulated E&P is negative 85,000 and current E&P is 15,000, and you have a dividend of 40,000, if we just netted these together, then we'd have negative 70,000, right? And so we'd look and say, hey, we got a dividend of 40,000, but there's no profits that we're paying this out of. So, basically we're going to have some other methods that we'll talk about later, but it won't be categorized as a dividend, right? However, this isn't how we do it. We don't net them together. We first look to current E&P. So even though we've got all this accumulated E&P and losses, we'd first say, okay, this 40,000, 15 of it is going to be a dividend, and that brings the current EMP to 0. And then we have 25,000 left, and we look then to the accumulated EMP, which is a loss. It's actually negative, and so then we really just have a $15,000 dividend. As for the extra $25,000 and what would happen to that, we'll talk about that in the videos to come.